So we have Michael Berman with us, and Michael, I apologize. I forgot that we've already talked once before, and you're recommended. Peter Brandt gives you a thumbs up as one
Yeah.
of the few guys that he would refer people to in the market. So how have you been? It's been
Ye-
a
Well,
while.
yeah, I think it's been about 6, 7 months since we spoke last. And firstly, happy birthday.
Thank you.
And secondly, thank you for the invite because you may recall I actually missed. There was an interim where I was
Yeah,
meant to present, and for some reason, I think times got the better of us. But anyway,
yeah.
it's actually very nice to hear so much Aussie talk there. You talking about the Aussie dollar.
You have a view on it?
Um, Not really.
Okay.
It it it's yeah. I'm gonna reserve. I've got
Judgment
dollar
on it?
Aussie dollar exposure already, so I
I will write down
anyway.
62.50. I'm thinking 62 would be a good entry if we pulled back there. So what's
Yeah.
on the docket for today, Michael? What do you want to talk about?
So I was just thinking, do you mind if I share my
Not
screen and
not at
maybe
all. Go
and
ahead.
then I thought a couple of things like popped
It's at
into
the bottom.
mind. Okay, just give me a second to get
Sure.
organized. Yeah. Okay. I think you probably should see a screen where it says signal to noise global macro and newsletter. Is that
We've
right?
got we've got it.
You you got it. Okay. So two things that came to mind were um, around biases that I thought, wow, maybe I should just tell you a little bit about two biases that came to mind. And just let me know as well. Can you see a PowerPoint presentation that I've just pulled
Yeah,
up?
got it. Going pro,
Okay.
the brutal truth about becoming a full-time trader.
Yeah. So
Does it have anything to do with this that people to try and sell you the secret to trading?
yeah,
There is no secret. It's hard
yeah,
work and living through
yeah,
adversity. And if that scares you, find
yeah.
something else to do.
Absolutely. So while you guys were talking, because I'll have to admit I don't trade like intraday at the moment like I did in the past. And but I thought of this. I gave this talk 2 weeks ago, and I thought there was one or two slides that might be interesting for some of you guys here. So the one I wanted to actually talk about was we live in this hyped up media world where we see the stars get a lot of airtime and things like that. And I just wanted to just show your audience um, how we tend to extrapolate from what we see. So just to give you an idea, the average NBA salary is $10 million per year. Approximately 500 players make it into the NBA. 610 million people play basketball globally. So the odds are negligible. But of course, we see it on TV, and you think if you're half decent as a basketball player, you're going to make the big leagues, and it kind of goes on to tennis and I also show it here as in the, the traders, the top 100 hedge fund managers earned an average of 1.2 billion, and then we see movies about billions and Wolf of Wall Street, and one tends to think that it's easier to achieve this kind of success than it really is. So I just want people to not fall for you know for the heavy selling, where they over glamorize, and but you follow what I'm saying here, that we only seen the people who are successful, and we tend to extrapolate that out to thinking a lot more people are successful. Now, I'm by no means telling
That's
people to
because
give up.
people only talk about their successes, not their failures,
Exactly. So, I
right?
mean, so there's a survivorship bias, there's a self-reporting bias. As you say, self-reporting bias would be where you only talk about your winners. No one reports about or puts on a leaderboard or on Twitter or whatever public forum you're on about your losers. Well, they tend not to. There's that inherent bias. But anyway, I write a daily global macro newsletter. It's free, so anyone is welcome to subscribe. But I wrote today about a bias that came to mind, and I thought it would be actually quite apt for your audience. So I wanted to show you how easy it is to avoid curve fitting a trading strategy backtest, but still curve fit it. So let me just walk you through this. It won't be very technical, but I'm sure you guys will follow the idea. So let's just take a classic 200-day moving average, and if the price is above the 200-day moving average, you go long. If it's below, you go short. And we won't go into the details of how you exit and all that, but basically that's the strategy. And I ran it on 12 global stock indexes going back to 1990. And sorry, this is right, yeah. And oopsie, this is the equity curve that came out. So this is a long track record. This is 35 years of back testing, and while it's positive, it's pretty dismal. I mean, it's 1.2% annual return, so nothing too fancy. But this is something that I noticed so many people. Now I don't know how many people in your audience are let's say systematic traders, but let's assume there's a fair amount. What people tend to do is they will go through the list. Here's the 12, and they see all the different results. So you can see S&P 500, the Nasdaq. Those were winners. The DAX was a winner, and so was this was the Swiss index. Okay, and the natural incline. What people tend to do is that they say, okay, well, I'm going to trade these four, the green ones. Those are the ones that I'm going to trade. What you're doing there is you are applying a bias. It's a hindsight bias, and that's not the way to go about a systematic backtesting strategy. So yeah, you see you're fooling yourself, and I see it over and over again. People tend to spend their whole day back testing, and then they look for the ones that produce good results, and they say, okay, that's my strategy now. You need a more robust approach to that than just that. I'm not going to go into the whole ins and outs of that, because that's a big subject, and I guess could take a bit of time. But I thought what I'd like to show you. I've got it's called research.signal-to-noise.news, and basically it's also free, this, and everything that I'm thinking and researching and doing, I put on this particular. I'm in the process of migrating a lot of stuff, a lot of my research that I've built, mainly quantitative, and I put it on here. I'll just walk you through a few of these slides, but basically you've got over here different watch lists, and they're color coded based on a Z score. Basically, if they are behaving abnormal to the way they've typically behaved in the past, it's a nice heuristic way of bringing your attention to something that is moving a lot relative to its past. So for instance, like Bitcoin might move 2% every day. So it's like, it is 1%. So it's not even colored, because it's well within a normal move. Whereas if you've got something, I don't know, like a Forex item, Forex would 0.41 is enough to trigger a color because of that Z score. So there's a whole bunch of stuff here. I'm not going to go into. You can play around. You can look at different things here, and kind of does some of the homework for you. Current drawdown, gold is 2.57%. But just to talk about some of the charts you guys were talking about earlier. So I like to I like to look at things very differently, maybe to some of you guys, where you like lots of lines and colors. I like everything clean and neat, and
Okay.
nothing on them, like bare bones and
Naked.
naked. You said it.
All right. All right.
Love it naked.
Keep your uh keep your shades drawn in the house.
Okay. So, I mean, this is a long chart. I tend to look at long charts. I mean, you could. I do have 1 year and 5 year, but I typically
That was
like
a
to look at
hell of a parabola right there.
yes. So it's exactly right. And so we've had an incredible run. I've been saying for some time now that I expect 2025 the S&P to produce a negative year. I'd I'd love it to be very negative, but and obviously with this recent sell-off from Liberation Day, I thought we were on our way, but who knows? We could still make one more high. Um, in uh, you know, I'll just talk a couple of themes here. I'm very bearish bonds, so I'm expecting yields to go higher. This is the 10-year yield, and um, for a whole host of reasons. Blake touched on that earlier, talking about the debt in the US and how much how many bonds are needed to be refinanced over the next 18 months is pretty significant. But um, I also thought I'd share some of. I'll just show you a couple of screens here that might be of interest to some of you people who don't want to necessarily, or you don't know where to find a yield curve. So, for instance, you've got the US yield curve. By the way, this everything updates daily, so it's not intraday. But I've automated it that it updates daily, so you can see different UK yield curve, Japan, China, a few things like that. One of the trades that I've been pushing for some time, and I've been on the right side of this one, is a yield
Steepening.
steepener.
Yeah.
So I, I've I've been very from way back in the inverse part. I've been calling for a steepening trade. I was at around over here. I was unsure if we were still, we might have still stuck around. I wasn't sure exactly where we were going, but I was very convinced that we were going to steepen. So that's proved right. And if you go even further out, it's even steeper if you look at the 30-year over the 2 years. So this is one particular trade that I've been very interested in.
Would you
Yeah,
call this move? Would you call this move almost embryonic, just starting first
yeah,
inning, second inning?
yeah. So we're sitting currently at 54 basis points up here. I see us probably there's scope to go. I would say 100 basis points. So we could go somewhere up here. I mean, we could go all the way up there. I wouldn't be so bold right now to say we're going all the way up there. But yeah, I'd say we're around halfway of where I would expect, um,
Okay.
where I'd expect things to go. The one thing we've been hearing a lot of noise about Japanese bonds. The 10
Yeah.
yield, yeah, can't really see it that closely, but we had yields that we haven't, this was prior to the GFC. So, I
Yeah.
think, and one must remember that the Japanese debt to GDP ratio is it's more than double what the US is. So a higher yield on their bonds is going to be pretty devastating to the economy. Um,
Is that the canary in the coal mine for a bear
yeah,
market? What's happening in Japan?
I think, yeah, I, th- I think what's happening is, we've all heard about kicking the can further down the road.
Yeah.
There is a limit to how far you can kick this can, and if you're a student of economic history, there was a great book. Yeah, somewhere this time is different or this time's not different. I can't remember the way it's worded again, but basically saying that if you look at hundreds of years of economic history, when you've got a GDP ratio above 100, debt to GDP ratio of over 100%, it's normally spelt the end. So, it doesn't mean it's going to roll over tomorrow or a year from now, but it's and we've passed that, and Japan's past 200%. So these
Yeah.
are the chickens coming home to roost. So I think one's got to be aware of that. What
Can
I've
you
been,
can you tell me
yeah,
why junk bonds
yeah,
have recovered so much better, HYG, even the
yeah,
corporates than the treasuries?
yeah. So to me, junk is another equity. The way the junk trades is, and just like we got this big bounce in equities, we've seen it. We've seen it with junk, but if I actually go back here, if we look at corporate um,
It's
spread,
almost like the flight to quality has shifted from sovereigns to
yeah,
junk.
yeah, yeah, it's ridiculous. It's you know once again very hard to time these things. But if you're a value player, or if you just think a little bit longer term, it's unsustainable where you've got such tiny spread premiums, and you just need a few bankruptcies, and these things are going to kind of take off. In fact, I just wanted to show you this. We've seen some big movement in term. So the triple C, the real junk, is actually trading um, at a significant premium to the other, let's say, less quality corporate debt. But it's still, if you look at it overall, that it's still way too low. So if you look at this chart, I've inverted the spreads. The corporate spreads are, so it's a blue line. It's inverted. We are very um, close to all-time, well, not all-time lows, but in a very, very low spread environment. But you can see there's a very strong correlation with the S&P 500. So um, yeah, if S&P, if either one of these roll over, the other one will follow, is likely to follow suit. Um, I wanted to
So
show you.
everything's about the April lows holding, isn't it? The
So
whole ball game is that
yeah,
the lows we had in April in a lot of
yeah,
things.
absolutely. So I wanted to show you over here some random charts. I wanted to show you. So yeah, here's a couple of things that that I swear by. Um, the 2 year is a better Fed chairman than Jerome Powell, Bernanke, Greenspan. Basically, the Fed funds rate follows the 2 year, so you can see how strong this correlation is. And I've got it here that the Fed's slightly behind the curve in terms of where the bond market is. The 2 year bond market doesn't mean I think that the Fed should be cutting any further. It just implies, this is what it implies, that the Fed is likely to cut further. I mean, if I would think they should do the opposite, because I have a view on inflation that is, I believe, tariffs and um, the current inflation is not going away. It's probably going to get worse. And I've got this analog that I thought was. I'm not
Wow.
normally the guy who is into these analogs, but this is, to me, this is the way I'm seeing it. So the green line is back from 1966 to 1982, where we saw that massive inflation,
Right.
and you can see, like, there was a peak, another peak,
Right.
and then the big peak.
Yeah.
And I suspect we are over here, and we've got another big peak to come. And I mean, that would be pretty devastating. We can all feel the cost of living pinch at the
Yeah.
moment. So um, if this holds up, that'll be a pretty devastating.
What gets us to the peak? It's got to be either Powell giving
Yeah,
up, focusing on economic weakness rather than employment. I
yeah.
mean,
So
rather than inflation.
I think the printing press is going to come out in full swing um, to mop up any of the new debt that's rolling over and going to be issued. We'll see quantitative easing again. which is going to be inflationary. We've got these trade wars that are going on. The fact that the market initially rallied because of Europe delaying, sorry, that Trump delayed.
Yeah.
We still got to. I don't think that's going away. There'll be a deal, and there will be inflation from that high tariff. I just
Do you
don't.
believe there were problems with the economy and market structure prior to tariffs, and that even if trade deals are done, it doesn't address the problems
Yeah,
we had prior? And
yeah. So
what do you think
yeah.
those problems were prior?
So look, I'm very anti the tariffs for the simple reason, um, it was working. Yes, there were some trade imbalances, but at the end of the day, there's an economy, let's say in China, that's able to produce stuff a lot cheaper than the US is able to do it, and the US was a beneficiary, and so is China,
Yeah.
um, and to suddenly overnight expect all that um, expertise to be able to be done in the US is it's impossible to replicate overnight what China has been spending
I
decades.
saw, yeah, I saw to make an Apple phone, which isn't even possible here in the U.S.,
Yeah,
that if
yeah,
they were able to do it, the phone would cost almost 4 grand.
yeah, I saw that. I mean, crazy, crazy. So funny. My brother-in-law called me, and when he saw my about 6 7 months ago, I put out a trade. Okay, so this was my trade idea, was to go long China, short the US. This is about 6 months ago. It
That
was
was huge. Yeah.
it was so if you look at this black line here, the ratio, it was around here, but I was too nervous to put the trade on by going long Shanghai, so I went long the Hang Seng, and so I put it out here. My brother-in-law said, "You're crazy!" Like, and he gave me a whole list of good reasons why China's got problems, and I don't disagree. China's got massive problems, but I felt the gap had widened too far in terms of where the US had gone relative to China, and China plays the long game and is able to, you know, juice the economy and do things that a democratic country is unable to do in the short term. So that was my view. And then I had a stop loss over here, and I thought, oh my gosh, we're going to get tested. I'm going to get stopped out, and it's actually the trade's gone my way
Yeah.
almost
It's been a great
from
trade.
yeah. So
Uh,
and I'm holding it because I'm not I don't think we're there yet. Um, there was I wanted to share.
I do have a question
Yeah,
from one of our community members,
yeah,
RJP. He's thinking ahead. What are the chances that AI increases productivity and causes deflation? Is that too
great
far ahead?
question. No,
Yeah.
great question. Um, so the to to support the market where we are right now, where are we here? In fact, here's maybe a great segue into this particular chart. So, in terms of economics, what needs to happen is productivity needs to increase to enable more economic growth. And there's no question that AI is a huge productivity enhancer. It's also the flip side of that is that it's going to probably lead to a lot
Well,
of unemployment,
right.
and 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 so obviously with unemployment there will be less demand, and there's a good chance that we'll get some deflation. So yeah, short answer is I think deflation's definitely potential. We're not there yet, and there's still too many other factors in.
That's about a few years out before
Yeah,
we
but
really start thinking about it.
it's really interesting, and without going too far down this particular tangent, Keynes spoke in the 40s about he saw a world where we would only work, I think, 20 hours a week maximum. No, was it less than that? I'm trying to, maybe even less, about 15 hours a week. And because of the productivity, that things would enhance and the standard of living would grow so well, was that we'd have so much more leisure time. The opposite has happened. I think we all work a lot more. Um, so I'm not sure what, it's a deep question, that what happens with unemployment, or
Yeah.
we able to, is there so much
All right.
productivity that yeah.
All right. Let
I'm
me get a
maybe
little
going
more
too
short
far down
term. Let me get a
there.
little more short term and we'll
Yeah,
wrap it.
yeah,
Any geo risk keep you up at night as kind of a
yeah,
exogenous event that could throw your trades into you know,
yeah, yeah.
big moves.
I would say that we've never been this. I mean, geopolitically, I mean, the tensions are there are a number of major wars taking place as we speak, and I'm talking physical wars, and then you've got the big trade wars, and um, when two superpowers like China and the US are facing off like they have been, uh, anything, yeah, the market is priced to perfection. I think there's every possibility that things could escalate further. Iran's a threat. There's a lot of things that are boiling over. I also think socioeconomically, the haves and the have-nots.
Yeah.
There could be more instability. So I think one's got to keep your wits about you. I think a market priced to perfection is dangerous, and yeah, keep then
Okay.
be very short term and also be very long term at the same. So small risks for the short term, and give yourself a wide berth on the long term.
Return of capital rather return on capital in this
Yeah, and
environment, huh?
and if people are on this call, still on this call, if there's one message I like to give out to people who are new, and even if you're not so new in the game, is that keep your keep your expectations realistic. Um, I I co-founded a fintech company. We were an analytics company. We had 100,000 trading accounts connected to our platform. So I've seen a lot of trading accounts, a lot of performance. I've incubated over 200 traders, and everyone's got these big expectations. And the
Yeah.
minute you play for that big stuff, you're likely to blow up. And if you can stay in the game, you've got a chance, and rather lower expectations and stay in the game.
Be a grinder.
Yeah.
Grind it out. That's what all the big guys do. They grind
You'll
it
never
out.
know how good you are. You'll never know how good you are if you blow up and you give it
Yeah.
up, and that's
Yeah.
a regret.
Yeah. Michael Berman, great to talk to you again. How do people keep in touch with you, Michael? Go to your website.
Yeah,
Could
the
also
best the
go
best
ahead.
would be to go to the website signaltonoise.news, and I'll respond to you can also go on the Twitter, the X account is I'm not that active on X, but yeah, feel free to reach out. I'll email you back, no problem.
All right. It looks like you're really getting in shape on that bottom picture down there. You're really ripped. Do you see it?
Am I still
Huh?
sharing the screen? I wish that was me. Uh,
anyway, there it is. There's Michael after the close.
yeah,
So,
there you go.
all right,
Thank you.
man. So great talking to you, Michael. Well, let's get back together in the summer. See how things are
Lovely.
going.
Enjoy your birthday.
All
Bye.
right, thank you. Thank you. Remember, everyone, don't just count your testing, your back testing. Count your blessings. Appreciate the happy birthday wishes. It's all bonus time now, bro. So thank you, everyone. See it for today was turnaround Tuesday. Uh, anyway, I'll figure out what day of the week it is later. And have a great day trading. Adios. See you, Glenn. Michael was great. Nuno, thank you. Adios, everyone.
Hey traders, this is Blake Morrow with Forex Analytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.